Hey guys, what's up? I'm Erin and welcome back to the channel. Anytime you're trying to determine how much you should have in savings for retirement, anytime you do research on this topic, inevitably some articles pop up saying you should have a target of $1 million. And by now I feel like we all know that 1 million is just some arbitrary number that doesn't pertain to anyone's situation. But I think it does beg the question of how many people actually have $1 million saved up for retirement? Well, the short answer is not many. Yes, this number makes headlines and it captures attention, but not many people hit this threshold. Let's dig into the data. If we dig into the latest research from the Employee Benefits Research Institute, or EBRI, here's what the current balances of all retirement accounts look like. The vast majority of accounts have under $100,000 in them, or just shy of 80% of accounts, with nearly 60% of accounts having less than $10,000. When we look at accounts that pass the seven-figure benchmark, we see that only 3.2% of accounts have hit this milestone. Now, it's important to keep in mind that this is strictly looking at tax-advantaged accounts. Think 401ks, 403bs, and IRAs. This doesn't take into consideration individual accounts like brokerage accounts. It's also important to keep in mind that many people may have multiple of these types of accounts. Say you worked for an employer for 10 years and had funds with them, left that employer, went to a new employer, opened up a new 401k, but never actually did anything with the old one. Maybe you just left it sitting there. So you could have multiple accounts. So it very well could be that someone has $10,000 sitting in one 401k and $50,000 sitting in another, and then maybe another one with $100,000 in it. The EBRI doesn't really have a way to weed through these multiple accounts, so I think we have to accept that this data does have some flaws in it. And according to Pew Research, it's roughly 30% of employees that have multiple employer-sponsored retirement plans. My guess would be to say that that statistic is kind of on the low end and probably climbing because we live in a society where it's far more normal to change jobs fairly frequently. It's more uncommon to see someone stick with an employer for 20, 30, or 40 years. It's more normal in our culture to change a job every 5 years or 10 years or maybe more frequently than that. And the more often you change a job, the more likely you are to end up with multiple accounts. Now, because the astute investor invests beyond simply their employer-sponsored retirement plan or beyond the Roth or traditional IRA that they may have, to get a more accurate measure of how many people actually have $1 million in investable assets saved up for retirement, we can turn to data from the Federal Reserve. According to the Federal Reserve, roughly 20% of all retirees have $1 million in investable assets across all accounts. I think that 20% figure seems more reliable than the 3% figure from the EBRI, but again, we have to consider the source. The EBRI doesn't have a way to look at investments beyond these traditional retirement accounts. So where did this $1 million benchmark come from? Why is it the number that so many people say we should target? Well, the idea of saving $1 million for retirement started to gain popularity in the late 80s and throughout the 90s, and there was a big shift taking place in the workplace during this time. In the year 1980, the very first 401k was established by a benefits consultant for his employees named Ted Benna. The 401k became possible because of the Revenue Act of 1978, which went into effect on January 1st of 1980. But the legislation was never designed to help employees create retirement accounts. But the law allowed employees to defer taxes on income they chose to receive as deferred compensation. And it was Benna who saw the potential to use this provision to create employer-sponsored retirement savings accounts. The 401k policy was a fluke. Now, this was also a time where pensions were sort of falling to the wayside, and Benna was once asked if he knew that his creation, the 401k, would come to replace the traditional pension, and he stated, "I didn't necessarily know that it would replace them. I knew that pension plans, with or without the 401k, were dying." So with the cultural shift of putting the burden of saving for one's own retirement on the employee's shoulders, moving from a defined benefit plan to a defined contribution plan, people had a new question to ask themselves. If I have to save for my own retirement, how much do I have to save? This wasn't really a question that people had to ask themselves before, especially if they worked for an employer who offered a pension. It was just assumed that you would make do with your pension and Social Security and whatever savings you might have, that proverbial three-legged stool we talk about. And $1 million started to gain traction as the goal amount that you should have saved up. It was a sizable enough sum that you should be able to sustain yourself throughout the course of an entire retirement. And then William Bengen came along in the 90s, and he first introduced the idea of a safe rate of withdrawal in a study published in the Journal of Financial Planning. Bengen's research concluded that based on historical data, a retiree could safely withdraw 4% of their initial portfolio's value, and then each subsequent year make an adjustment based on the previous year's inflation, and that would allow their portfolio to last reliably for a 30-year retirement. It's worth keeping in mind that Bengen himself never even called it the 4% rule. That moniker was bestowed upon his philosophy by the media because it made for a good headline. But the 4% rule nevertheless helped to drive home the importance of saving $1 million for retirement. In 1990, the median household income in the United States was roughly $30,000. By 1995, it was about $34,000. And by the year 2000, it was $42,000. $40,000 was a typical income, and the idea of creating a portfolio that could generate the typical income for you in retirement was common sense. And now we had a rule telling us exactly what that portfolio needed to be to create $40,000 in income, which is that magical $1 million when you apply the popular rule of 4%. This further cemented the idea of needing a $1 million nest egg in people's minds. And it's worth pointing out that having $1 million invested in the 90s was incredibly rare. In 1996, about 1% of U.S. households were considered millionaires in terms of investable assets. By 1999, approximately 2% of U.S. households held $1 million or more in investable assets. So still, even though this goal was being popularized, it was very much a benchmark that was associated with high net worth individuals. The media itself really helped to cement the idea of saving $1 million into the minds of workers. The media really took the 4% rule and emphasized the burden of having to save for your own retirement and splashed their covers and their headlines with the subject of $1 million. $1 million became a very popular number featured in practically every headline you can imagine. It was talked about on news stations and featured in Money Magazine and Kiplinger's magazines, just very popular personal finance publications. And slowly but surely, this number became deeply rooted in our association with wealth and retirement and success. And there's big psychology to the number 1 million as well. It's a nice, clean, easy number to remember. It's easier to say I'm aiming for $1 million than say I have the target of $831,000 or $1,172,000. Those aren't as simple numbers. They aren't as catchy. They don't have their own name. And more than that, and more than ever, while this number did seem aspirational, it also seemed possible. And it seemed possible because those 2 decades saw a booming stock market and great wealth accumulation. The 1970s was kind of a period of stagnation. However, the 1980s were a period of recovery and optimism. The S&P saw an annualized return of around 17.3% from 1980 to 1989. Yes, we did have Black Monday in October of 1987, right when I was born, where the stock market fell about 23%. But the recovery was fairly quick and the decade finished strong. Then into the 90s, we had one of the longest bull markets in history up to that point, and it was fueled by tech-heavy stocks. The 1990s was a period of unprecedented growth, with tech-heavy stocks fueling one of the longest bull markets in history up to that point. The S&P delivered an annualized return of about 18.2% from 1990 to 1999. The tech-heavy NASDAQ gained more than 400% from 1995 to 2000. With decades of double-digit growth happening, people started to think that this is what the stock market would do forever. They stopped thinking that, we have to use a conservative 7% rate of return, or even forget the 10% annual rate of return. People started running their projections using a 12% annual rate of return because that's what recent history had shown them. But long term, there was a reversion to the mean. We had the dot-com bubble burst, and the more history we get under our belt, the more we realize that things tend to revert to the mean. But with a booming stock market and more people getting invested, the seven-figure milestone became more and more a real possibility in people's minds. I remember for me, it was the year 2000 and I was in Mr. Hill's econ class and he was telling us that we just had to save $100 a month and we could all be millionaires by the time we retired. This was also the class where I got real hands-on experience with the stock market. We had this online stock market game where we were given a fictitious $1 million portfolio and allowed to invest in whatever company we chose, or multiple companies. And the goal was to build the largest portfolio you could by the end of the semester. And being that I'm very competitive by nature, and at this point I had already loved investing, I was like, this is my moment to shine. This is my time to show off my skills as an investor. And shine, I did not. I didn't come anywhere close to number one. I don't remember where I came, but so far from number one. But that was a really important lesson to learn at 13 about day trading with fake money. It saved me from having to learn a lesson at 30 about day trading with real money. But to this day, it is still one of my most memorable class assignments. So with workers having to take on the responsibility of saving for their own retirement, with financial planners coming out with the suggestion of how to make your money last, with media outlets nonstop printing a headline including the number $1 million, telling us that that was the goal, living through years of unprecedented stock market growth, slowly but surely $1 million became ingrained in the psyche of Americans that this is the number we should save for retirement. But there's one more thing to keep in mind. $1 million back in 1980 is the equivalent of nearly $4 million today. $1 million back in 1990 is the equivalent of about $2.5 million today. And $1 million back in 2000 would look more like $1.9 million today in terms of purchasing power. $1 million is a fine goal. I don't have anything against it. Most people don't hit it, but if you start early and save diligently, you can. Inflation does mean that over time, it will not buy as much. But at the end of the day, how much you need depends on your personal situation. I just thought it was kind of fun to see how this number became so deeply ingrained into the American psyche and the personal finance space. What are your thoughts? Did you learn anything in this video? Leave a comment down below. I post new videos every single week. If you got anything at all out of this one, please give it a like. If you're new here, please consider subscribing, or if you know of someone who might get something out of this type of content, please consider sharing. I'll see you soon. Bye. What is with the lighting in this video? The clouds are playing tricks on me today and I don't like it. I have a way to look at plans that are the 401k. Slow down. Jeez, oh Pete's. The 401k. No, that was the opposite. It was still too fast. And more, I think my hand was like this in the last one, so I'm trying to make it cohesive. Okay, but okay, let's do it. We like one sentence and we're done. We got this.